Good morning, everyone. Good afternoon to some folks. My name is Ari Rubin, and I'm the founder and CEO of Flock Homes. Thank you to CRE for partnering with us today on this podcast. I'm psyched to present a webinar today on the 721 exchange, a smarter exit for retiring multifamily owners. Today, we're going to talk through exiting from real estate, 1031 exchanges, 721 exchanges, retirement, passive income, and lots of other interesting things. Great, let's kick it off. So just before we start, a little bit about Flock Homes. We are the country's largest direct 721 exchange provider. We started the business about 5 years ago with 4 homes in Denver. Today, we have almost 50 people on our team across the country. We've got tenured executives from some of the country's largest real estate firms, Progress Residential, State Street Global. Our Chief Business Officer, Chad, spent years at JP Morgan working on 721 exchanges before joining Flock. Alex Satina comes from a commercial real estate background from Tishman out of New York. And then Richard Pickering and William, our COO and head of engineering, come from more of a fintech background from Wealthfront, as well as from in real estate and prop tech from Open Door. So we started the company again about 5 years ago and with 4 homes, and here we are today. Let's dive in a little bit. So the reason we're on this call today is because at some point, you are going to need an exit. Every real estate owner knows this. They don't always think about it in the early days of their career, but essentially everyone on this call, a lot of folks have, or they know folks who are like this. You've spent decades building your real estate portfolio. You've navigated rate cycles. Most of them have been favorable until the last couple of years. There's been rent regulation. There's been difficulties in the financing environment, transactions. And if you're on this call today or you've gotten to this point in your career, you've built up a lot of equity in your real estate. You have had very low basis, and you've gotten that to a point where today you need a thoughtful exit. And we started Flock to really build the retirement solution for landlords, to offer a really unique solution for the millions of landlords out there who are facing this problem in the coming years. So what we're going to cover today a little bit is, to start, is the cost of selling. When you sell your real estate, what are the actual costs involved with that? We'll then walk through some of the options available for retiring landlords. We'll then dive specifically into the 721 exchange, what that is. And then we'll talk a little bit more about Flock, our company, some of the clients we've worked with, and then we'll open it up to Q&A at the end. So let's start out with just the problem that we set out to solve at Flock, which is at some point, you're not going to want to own your real estate anymore, but selling is very costly. And the reason that selling is costly is, first and foremost, the taxes involved. You face not only capital gains, which, depending on what your income bracket is and what state you're in, could be in excess of 30%. You also pay of your gains. You also pay depreciation recapture. As everyone here knows, depreciation is great when you own real estate. It's very painful when you sell it. So again, when you sell your real estate, you trigger capital gains taxes, you trigger depreciation recapture. And then, depending on the type of asset that you're selling, there's lots of time and work and hassle involved with getting ready for a sale. If you own single family homes, you might have to kick out your tenants, your residents. That's not a very nice thing to do. If you own multifamily, you may need to do something similar to get your rents up to market, to get best price execution. There's just a lot of work and hassle involved with listings. You've got multiple stakeholders. And so, in short, you lose a lot of your value in a traditional sale, as well as lots of time and hassle. This could take months to do, especially in this transaction environment where interest rates remain high. Especially in multifamily, there's been a lot of excess supply coming online in the last couple of years. A traditional sale is just very, very costly from both a dollar and time perspective. So many people know that, especially people on this call today, which is why people oftentimes use something that's called the 1031 exchange. The 1031 is essentially at this point a real estate loophole. It used to apply to other asset classes in addition to real estate, but it's a part of the tax code that has existed for a very, very long time, which essentially says that if you sell your real estate, you can roll the proceeds into another like kind piece of property, and that defers the taxes. So rather than triggering capital gains as well as depreciation or capture, you can defer those gains, those taxes, and ultimately roll the entirety of your equity into another piece of real estate and defer those taxes, with the hope, with what many people do, is try to hold on until they can pass that asset onto their heirs who receive what's called the step up in basis. So the 1031 exchange is a tried and true strategy that most real estate investors know about. There's kind of two primary ways you can do a 1031 exchange. The main, most popular, most common way is to just 1031 directly into another property. You can 1031 single family homes into a multifamily building. If you're looking for something a little bit more passive, you can 1031 your proceeds into a triple net. There's many different asset classes you can go into. Maybe you want to get higher yields, so you 1031 out of state. Maybe you want to get more stability, and so you 1031 to something closer, right? A different type of assets. The other thing that you can do with a 1031 exchange is 1031 into what's called a Delaware Statutory Trust. We're going to talk about that in a little bit. It's something that is similar to real estate, similar to a fund, but not exactly either. We'll talk through that a little bit more. But the main summary, I think many people here are familiar with the 1031 exchange. You cannot receive the proceeds. You have to work with a qualified intermediary to do so. And within 45 days and 180 days, you have to follow this timeline, as well as some other nuances like matching your debt, finding replacement property, so on and so forth. We'll talk a little bit more about this shortly, but that is the high level of what the 1031 exchange is. It's a tried and true strategy that many real estate investors have used over the years. So a 1031 doesn't really solve your problem. If you are at that point in your ownership where you've owned for decades and you don't really want to be a landlord anymore, a 1031 really just kind of kicks the can down the road. And some example of that, first and foremost, with a 1031, you still own real estate. So if your goal is to retire from being a landlord, you don't really accomplish that with a traditional 1031 exchange. You can go from owning a portfolio of single family homes to owning one building, or you can go from owning one apartment building to owning a triple net lease property where you have very, very little to worry about on a monthly basis, but you still actually own those sticks and bricks. You still own that dirt. And for many people, they like that control. If you want to continue being an active real estate investor, that's great. If you want to be hands-on, that's awesome. But you still do own real estate. And for many folks, especially those who are approaching retirement, that doesn't really solve their problem. Sort of part of those are some other implications, such as liability still rests on you. In a triple net property, if 5 years from now that tenant decides not to renew their lease, that's your problem and your box that you got to deal with. If you own an apartment building, those are your tenants, your property managers, your capital improvements that you are on the hook for. Another thing with a 1031 exchange that you have to be really careful about from a tax perspective is you have to match your leverage ratios to avoid something what's called the boot. And so for a lot of folks, especially if they've done cash out refis over time, they have very low basis. They have some amount of debt. They have to find new debt. And that could be problematic, especially when the 10-year is now approaching 5%. So again, interest rates are at a 20-year high right now. It's hard if you want to trade out of one property and take on a new one. It's hard, and a lot of people don't really want to take on new debt. Um, to sort of summarize, the 1031 exchange, again, a long time part of the tax code. It is really built and was designed to sort of maximize real estate's highest and best use, to encourage real estate investors to trade in and trade out, to encourage better land use. It's really good for building a portfolio and building your equity, your nest egg, but really not that great for exiting. Many people are familiar with another option that the 1031 exchange affords, which is called the Delaware Statutory Trust. And essentially, a Delaware Statutory Trust is a structure that a bunch of smart lawyers got together and created a couple decades ago, which allows you to 1031 your proceeds into a vehicle, a trust that owns real estate. So, as part of a 1031 exchange, you have to roll your proceeds into what's called like kind real estate. Some lawyers got together and figured out a way to create a trust which is not exactly directly owning real estate, but is a way to own real estate. And it's a great structure if you want to be more passive than owning the real estate yourself. So effectively, what it does is it allows you to continue to have that real estate ownership directly, but instead of it being your name on title, it's a trust that you and a bunch of other investors go into together to own that piece of real estate. One of the challenges, and usually there's many Delaware statutory trusts out there, they've gotten very, very popular with financial advisors over the last couple of years. Only 10 years ago, it was just $1 billion or $2 billion a year of volume. Now it's $10 billion of volume a year. Again, it's a very, very popular option. Many of the largest financial institutions and private equity firms in the world offer the Delaware Statutory Trust, as well as the 721 that goes with it. One of the challenges the biggest challenge that we hear on the DST is fees. And that's really for two reasons. Number one, there's a very large fee load that you pay to go into the DST. And then there's also lots of expenses associated with managing the Delaware Statutory Trust on an ongoing basis. So just one very simple example, in order to sort of comply with what they call the 7 deadly sins of a Delaware Statutory Trust, you have to structure it in such a way where there's a lot of restrictions. So, for example, you can't renegotiate a lease. You can't do additional CapEx beyond what you budgeted at inception. And so when a sponsor designs this trust, when sort of the main partner or the issuer or the firm that runs this thing, when they design it, they have to have all of these layers of master lease agreements and buffers and to account for all the restrictions involved with owning a Delaware statutory trust. And so as a result of that, they just bake that into the fees. And so a typical DST load, it could consume upwards of 10% of your equity just to get into the thing. And often you got to be very careful when you're due diligencing these things because a lot of them, they don't, it's in the fine print what the fees that you're actually paying are, or they advertise it with a very high yield profile, but you don't see that you're actually paying, a very, very large fee annually as well as upfront. So the DSTs, again, it's a great way to get into a passive vehicle and to do that tax deferral, but the fee load is very, very high. Another big drawback to the DST is you're effectively just kicking the can down the road. So if you go into a DST, let's say you sell your apartment building and you 1031 into 2 DSTs, those DSTs have a finite life to them. And that is 5 years, 7 years, it could be 10 years. And when that's done, you've got to do it all again. And so if you think you want to continue being 5, 7, 10 years from now, you perhaps want to go back and be an active real estate investor, this is a great option for you because you can kind of think of it like being in a holding pattern, right? You 1031 into this thing, you wait 5 years, 7 years, 10 years, and then you can 1031 out and go buy more real estate. So if you think down the line that's the route you want to go, the DST is an awesome, awesome option for you. But if you're like, I want to retire from being a landlord and I want to go passive, well, you're really just kicking the can down the road, because a few years from now, you're going to have to liquidate that DST interest and then do it again if you want to get more tax deferral. So just to summarize that point, it's a great option if you think you might want to be active again in the future. If you're ready to retire, all you're doing is just sort of kicking the can down the road. Another big drawback to the DST is you are typically concentrated in one asset. So when the sponsor creates the Delaware Statutory Trust, they typically just drop one building into that. So perhaps a triple net lease property, perhaps it's a multifamily building, or a hotel, or a built for rent community. Whatever it is, you are concentrated in one asset. And as everyone knows, diversification is the only free lunch in investing. If you're concentrated in one asset, that could be a very good thing if that asset performs. But most people who are doing this, they're looking for low risk. And so if that asset doesn't perform, for whatever reason, whether it's the capitalization, the debt doesn't perform, or there's a refi that's needed, or there's additional capex that's needed, it could get ugly, and it could get ugly pretty fast. So again, one of the drawbacks to the DST, it's the nature of this legal structure, is that you are concentrated in just one asset. Many people are familiar, and there's been a lot of popularity with a DST into a 721 exchange. And so effectively what that means is you 1031 your proceeds into a single asset that is then rolled into a REIT after a couple of years. It's a great option, and many of the large private equity firms offer this. But again, fees really matter, and it's just the nature of what a DST is, the cost of setting up this legal structure, the restrictions involved with the 7 deadly sins, as well as the first transaction and the second transaction to come into the REITs. There's just a lot of fees baked into it. And so you just got to be really mindful of that when you're evaluating DSTs. So again, just to summarize this, the Delaware Statutory Trust can be a great option for a lot of people. I'd say if you want to continue to be an active real estate investor, it's a great holding pattern for you. It's also a great way to get tax deferral. And if you can find the right sponsor, it could be a good option. You just got to be really mindful of those fees. So we're now here to talk about the 721 exchange, which, as we've talked about, has been part of the tax code for many decades. There are a lot of firms that offer this. We're the first firm to offer this to the millions of Americans who own small rental properties out there. So we started with single family homes. We now do multifamily buildings. The 721 exchange has been part of the tax code. It's not a real estate loophole. It's been part of the tax code for many decades. If you own a very large commercial real estate portfolio, hundreds of millions of dollars, you're probably familiar with this. REITs offer this to very, very large owners all the time. No one has, for lack of a better term, democratized access to this really, really powerful wealth building and wealth preservation mechanism until now. So let's just quickly talk through some of the benefits, and then we'll talk about how it works. In short, you contribute your property directly to an operating partnership under the Section 721 of the tax code. So you own an asset, you exchange it directly into the partnership, and on an ongoing basis, you still get all the benefits of owning your real estate. You get appreciation and income, but you no longer have any of the burdens, right? You are not liable. You don't own the asset anymore. You are fully passive. You are diversified across all the properties that sit in the partnership, and it's a seamless one-step transition into getting into the partnership. You don't have to go through deadlines. You don't have to go through a qualified intermediary. You simply exchange your property for shares in our fund. So again, just to talk through how this works, you own physical property, and rather than selling that and taking the proceeds, having it sit with a qualified intermediary, having a 45-day and 180-day period to time this thing, it's simply you own a property, you exchange it into the partnership, and you now own units in this partnership. So you go from owning your own real estate, which your returns are driven by, number one, what the market does, the change in value of the real estate, as well as two, the net income of the real estate, right? Your rents less your expenses. You exchange this into a partnership, and you now get the same exact benefits that you would have from your own property, but rather than it just coming from your own individual building, it comes from a much larger diversified partnership that owns many, many buildings. So you no longer have to manage the property. You no longer have to collect rents. You no longer have to deal with a property manager. If something happens to your own building, you are no longer liable for that, right? You now own units or shares in this much larger, much more scaled portfolio that owns real estate all around the country. So that is what a 721 exchange is. It's worth just kind of restating that similar to the 1031 exchange, this whole transaction is not a taxable transaction. It is a tax deferred transaction. So when you relinquish title, because you're actually relinquishing title as part of this, there's an actual settlement statement. When you relinquish title and you receive units, there are no taxes triggered on that moment of the exchange. And that's because you don't receive cash when you do it. You receive shares or units in this larger partnership. And so it's not deemed a sale. It's not deemed a taxable transaction. It's a great way for individual owners to go from owning one individual building to now owning a portfolio of more institutional quality assets. And then again, kind of most importantly for folks who are approaching that next phase in their real estate ownership life, it's no longer requires you to be an active manager of the real estate. You are fully a passive, you fully are a passive shareholder in this larger partnership. So that is just a very quick kind of summary of the 721 exchange. Again, it is very similar to the 1031 exchange in that you relinquish title to one property and you achieve tax deferral in doing it. But rather than going through a qualified intermediary, a 45-day identification, 180-day actual closing period, there's no timing deadlines. It's just one very, very simple, seamless transaction. Great. So just to look at some kind of summary numbers here, if you are outright, it depends on what tax bracket you're in, what jurisdiction you're in. If you're doing an outright sale, as we talked about, you could be losing 30% of your equity to taxes, as well as to sort of closing costs and so on and so forth. Almost 30% of your equity. And most real estate investors know this, which is why very, very people do an outright sale. And that, again, doesn't even account for all of the time, which arguably at your stage in life, depending on where you are, could be the most important thing, right? So it's not just about compounding your wealth, it's about compounding your time. An outright sale is definitely a very kind of costly process to doing it. The other option is 1031ing into a DST. On average, the fees just to get into those things, the fee, the broker transaction costs, as well as the qualified intermediaries and the placement fees associated with a Delaware Statutory Trust are very, very high. And so for a lot of folks, again, they could be seeing 10% slippage, 12% slippage just to get into these things. The beauty of working with a direct 721 exchange provider is you just, again, it's about that word direct. You own an asset and then you seamlessly transition into owning shares in a larger partnership. And that's just a really simple, clean, direct, and very, very cost efficient exit. And of course, that loss of equity matters a lot, not just today, but as you think about the 5, 10, 30-year outcome of your investments, when you lose that much equity up front, it takes a lot longer to recover that, right? That is your wealth that should be compounding. So once you exchange into Flock, what does that mean? What does that look like? So again, just to sort of highlight, because I know this is a big reason that a lot of folks are on this call and that they look at tax deferred exits. Just to start with, you get tax deferral when you come into Flock. So again, just like a 1031 exchange, when you do a 721 exchange, you relinquish title, but in doing so, there are no tax, no capital gains, or no depreciation recapture triggered. Your entirety of your equity rolls forward into the fund. You maintain your own tax basis. You stay on your own tax basis trajectory, which we can talk about a little bit more. But as a result of that, no taxes are triggered. I will just add that there are a few nuances whereby there could be some very small amount, there could be some tax triggered. It depends on if you've done cash out refis and certain nuances that are called disguise sales that we can talk about shortly. But for the most part, we at Flock have done hundreds of these exchanges, and for the 99% plus of our clients have no taxes triggered on that exchange. The second big thing, now that you are a shareholder in the Flock fund, you still get cash flow on a quarterly basis, as well as all the upside from our real estate portfolio, just like you did before. So we pay out cash flow on a quarterly basis. If some of you are familiar with a real estate investment trust, with a REIT, or any kind of private fund or real estate syndication, many of them pay out quarterly as well. We do that also. We have never been a day late or a dollar short on a cash flow payment. We have hundreds of clients in Flock, hundreds of families that have entrusted us with their nest egg. Some of them just leave their cash flow reinvesting. That increases your basis, helps you compound. We have other folks who live off that cash flow, like Social Security, and it's a big part of their retirement income. And they take that, they treat it very importantly, and we treat it as really a sacred item. And so we've never been a day late or a dollar short on our cash flow. You'll know exactly how much cash flow you can expect from the partnership when you're evaluating Flock. And by the way, with any investment that you do, you should be evaluating how much cash flow, what you can get, what the risks are associated with it, right? At Flock, the way we run, we are very conservative. We run with very, very low leverage, and we treat this quarterly cash flow as very, very sacred. Another big benefit, obviously, is you continue to get the exposure to the real estate market. So we very much believe in residential real estate. We very much believe in this country, and we think that there is just a shortage of quality places to live, and affordability remains very tough for a lot of people. And so there will always be a strong desire for rental housing, which is why we started this business in single family homes and now in multifamily. And you will continue to get all that upside from the real estate now that you own shares in the partnership. It's worth stating the obvious that just like your own real estate, the real estate in Flock's portfolio can go down in value, right? That's what happens when you own real estate. We are very thoughtful about the buildings that we bring into the partnership. We're very thoughtful about how we underwrite. We have a number of mechanisms in place when we value your properties to make sure that we are only selecting properties that meet our criteria, that we can operate efficiently, so on and so forth. But all of these things together, right, just to sort of remind you and to summarize, you continue to get all the cash flow and you continue to get long-term appreciation in the partnership that you now own shares of. 3 other benefits that I want to touch on. The first one is flexible liquidity. So for a lot of people in Flock who have worked with us to date, this is their legacy that they want to leave on to their heirs, who will then get the step up in basis. For a lot of other folks, this is something that they intend to draw down, they intend to liquidate over time, similar to an IRA or a 401k. And they can do that not only with their quarterly cash flow, but also by liquidating their shares in the partnership. And the really, really powerful part about going into a partnership like this is you can actually do this flexibly over time. So let's say you have a $5 million building. If you want to liquidate that, you really only have one option at this stage in your ownership journey, and that's to sell. And that's going to trigger, as we've talked about, a massive tax liability. What's beautiful about owning shares in a partnership is when you decide to liquidate that, it's not treated as a sale. If you liquidate the entirety of it, it is treated as a sale from a tax perspective. But there's ways that you can liquidate part of your account. And rather than the IRS treating that as a partial sale, they treat it as what's called a reduction in basis. And many of you are familiar with this concept because you've done cash out refis over time. But to summarize, what this means for you is you're able to liquidate a large part of your account without triggering any taxes on that day. Now, those taxes aren't eliminated, you just defer it. But if your intention is to pass that on to your heirs who receive the step up in basis, then similar to any sort of depreciation or reduction in basis, they will benefit from that step up. So again, you can liquidate a big chunk of your account without triggering any taxes on that today, which is a great thing for today and for the next couple of years and for setting your family and your heirs up for that really powerful step up in basis. Another great thing, and just to lastly conclude on liquidity, I think this is really important. I would say that the majority of our clients in Flock, they have heirs that they want to pass this on to. We also have a lot of folks who they don't have heirs and they intend to just liquidate this over time. And our view is, again, if you have an IRA or a 401k or a pension, you get to access that in pieces. It's flexible. It's on your terms over time. Whereas in real estate, you're kind of just stuck with all of your equity just trapped in one building. And the beauty of this is it's a way to transition into that really rigid kind of ownership structure into something a lot more flexible, which is how your wealth should be. The last two benefits that I'd like to touch on are diversification. I said it once, but I'll say it again. Diversification is the only free lunch in investing, right? Typically, you have to, if you want to reduce your risk, you have to buy insurance or you have to layer on some other financial instrument to protect yourself. The best way and the free way to do that is to diversify, right? It's not just having all of your eggs in one asset or in one market. It's having them spread out across different property types and across different geographies. Many individual real estate owners already do that, right? You don't just own one building, you own multiple. One of the beauties of multifamily is you don't just have one tenant, you have multiple tenants. But if something happens to that building, it could really spiral downward very, very quickly. All of your risk is concentrated in that one building. One bad tenant, one bad, flood or natural disaster, whatever it is, or simply a market downturn, right? And the reality is no one knows over the next 10 years or 30 years what's going to happen in your specific market. I talk about this with our clients all the time. When we think, that's the timeline that you should be thinking about when you own real estate. And, we heard this when I started the business back in 2021. Everyone said, we started the business in Colorado and everyone said, Denver is the next New York City and it can never go down in value. And the same thing with the Sunbelt markets. People were hearing a lot about Phoenix and Florida and Texas, right? 5 years later, those are markets that are under a lot of pressure. And by the way, we still very much believe in those markets over the long term, but no one could have predicted, or very few people predicted that 5 years ago, what the real estate market looked like today. The experts didn't predict it. No one predicted it. And the reality is no one can predict the future. Only God knows what's going to happen. And so as a result of that, we like to diversify. Again, it's the only free lunch in investing, and it's a really prudent way to own any assets, your stocks, your bonds, right? Diversification is a prudent way of investing. Why wouldn't you do that with your real estate? Lastly, the last main benefit to having shares in this partnership It's just like your own real estate. It's a very, very powerful estate planning mechanism. So today you own real estate. Tomorrow you do an exchange into the Flock partnership or into another partnership. Now you own shares in the partnership. Those shares, just like your own real estate or your stocks or whatever else you own, you can pass on to your heirs who would then likely receive the step up in basis. When your heirs do that, rather than having four heirs figure out how to liquidate one single apartment building or how to liquidate 12 single family homes, right? That liquidation event is not always seamless. You've got to, fix up the building. Who's responsible for what? You've got to deal with brokers. You've got probate. You've got a bunch of other stuff that you're dealing with. Most heirs don't really want to be dealing with that. They want something more fungible, more flexible, more liquid. And that's what the partnership provides you. So it's a really, really powerful estate planning mechanism, doing something like the 721 exchange into something like the Flock partnership. So just a little bit more history on our firm. We launched in 2021 with 4 homes in Colorado, which I realize many people are laughing at. That's less homes than a lot of people here on this call today have, but you got to start somewhere. And when we started, we were very deliberate about doing this right. We started on day one working with the top law firms, the top tax and audit firms like KPMG, and many other leading service providers to make sure we did it right from the very, very beginning. We knew that if we built it, they would come. And sure enough, they have. We are now approaching 2,000 homes, 2,000 units across the country. We're in a bunch of markets, what we consider sort of growth markets. These are markets that have come under a lot more pressure the last couple of years, markets like Arizona, Colorado, a handful of markets in Texas. And then we're in a lot more sort of what I call like stable markets that have more yield still, kind of the Rust Belt markets in the Midwest. And so we have taken this diversified approach since launching 5 years ago. Colorado was our first market. It still remains our largest market by dollar value. But we also have a substantial presence across the country and a world-class team across the country managing our real estate. One other thing that I want to highlight that is very, very important here, when you look at DSTs or private funds or REITs, you always have to look at not only the fees and of course the team and the people involved, you also have to look at the risk reward. And at Flock, we run at very low leverage. We run at typically around that 30% loan to value number with very, very strong DSCR coverage. Now, we have a lot of clients who come to Flock and they say, they say, what kind of returns can I expect in Flock? And I walk them through that and I talk about cash flow and I talk about mirroring exposure to the long-term residential real estate market, right? And when I say these numbers to people, they say, I want you to target 15 to 20% returns. And I say, there's a lot of places you can go get that, but that's not what we built Flock for. Flock is about capital preservation. It's about peace of mind. It's about a seamless transition to passive ownership. It's about estate planning. It's about your legacy and making sure it's there for the rest of your life and for anyone else who's going to count on it. And so as a result of that, we run at very, very low loan to value. If you love this idea, but you'd prefer to go into something with higher risk and higher reward also, it's not a bad thing. It's just different. We'd be happy to recommend a couple other providers out there. It's just the way that we operate. I said it earlier and I'll say it again. We've never been a day late or a dollar short on a cash payment. It's really, really important to us. And the way we do that is we maintain this very low leverage, low risk profile. So it requires us to say no to a lot of real estate. It requires us to be very conservative in our underwriting. It requires us to sometimes to pay out, less cash flow, right? A lot of clients come to us, they say, I want more cash flow every quarter. And I'd say, I'd love for one day to surprise the upside, but I'd rather under promise and over deliver rather than the alternative. So I just want to be very direct with folks at Flock. We run very low leverage. There's other 721 exchange providers out there who run at higher leverage. We'd be happy to make those introductions to those firms if you're interested. I think one of the most powerful parts of building this business and doing these exchanges, acquiring these assets, bringing them into the fund, and then managing them on an ongoing basis is this really simple but very powerful fact that behind every building is an owner and their legacy, and oftentimes their family's legacy. And again, what's unique about this is it's really a partnership. You don't just sell your building and roll your proceeds into some Dollar General in the middle of nowhere, right? You are taking your building that for many people they've owned for decades. We have buildings that have been owned for multiple generations, 70 plus years. We have buildings that they are on a street that is named after the family that originally built that building, who is now a Flock client. That's really powerful. That they're entrusting us with their legacy, that we're able to carry that on for them. And we take that really seriously, not only in the upfront education process, but also in the ongoing management of the buildings that we take on. One client here, Stan, was a very, very early Flock client. He had built his buildings himself. He had done single family and small multifamily, and he had done this himself. He was originally a home builder. He had moved on in life, and he just realized it was time to pass the torch. And he had a local crew, a local operation in Kansas City where he had previously owned. And when he came into Flock, it was a great transition. We kept a number of people from his team involved with our operations. So it was a great way to sort of up level some of his team members, set them up with a much more scaled national company where they could achieve career growth. And of course, Stan could benefit from all of the things that we've talked about today: peace of mind, passive ownership, flexible liquidity, cash flow, and obviously, first and foremost, of course, tax deferral for a lot of folks. So Stan is just one of our many clients. I know the exact buildings that Stan put in. And even though we've scaled now to hundreds of families and thousands of units around the country, myself and our team, we still know those people, and we track those people of who put in the buildings and what those are. And we still rely on those people as well. You're not on the hook for anything, but we keep in constant contact with our clients and communications, not only through quarterly earnings calls and monthly updates, but through a portal where you can see every home, every building that we own on a real-time basis to really just check in on what we're doing, how we're doing, and how the properties are looking. So Stan is just one of the many, many success stories. We do a lot of client events in person as well as virtually, fireside chats. Our Flock Exchange, an annual summit that we do for real estate owners who want to learn more about the exchange and learn more about passive ownership. So we do a lot of in-person events. We also do a lot of client reference calls. We're really proud of the community that we've built. And if you're considering an exchange for Flock, I'd invite you to sort of join us in one of these events to learn more, not just trust our team and our word for it, but also to interact with some of our other clients. We'd be happy to set you up with some of them. So that's a little bit about Flock. We'd love to tell you a little bit more, to learn more about your buildings. You can get in touch with us by sending us an email to info@flockhomes.com. You can also go on our website and go into the chat and just input a chat there. You might hear from one of my colleagues, Michael. You might hear from Ethan. You might hear from me as CEO. I'd really welcome and love the opportunity to get to know you, or some of the people on the acquisitions team who help our clients work through exchanges. So please don't hesitate to reach out. We're at a really exciting time of our growth, and we'd love to hear from you if you have a building or a situation that might fit. So with that, I'll pause there. I saw a lot of questions coming into the chat, which I'm excited to dive in here. So let's just take a minute here. If you have questions, feel free to enter them into the Q&A. I'll take 1 minute here, and then I'll start answering them. Okay, great. So a lot of good questions here. A few that are sort of similarly bucketed. I'll start with the first one, which is around distributions. We pay out our distributions quarterly. We also revalue our portfolio on a quarterly basis. And I want to just talk through very quickly how that works. We own all the homes and the buildings that have come into the partnership. Every quarter, we use third-party valuations to revalue all of those. And we then report on that in our quarterly earnings calls and our updates. We also use third-party appraisals on a sample of the portfolio with the requirement that every asset is reappraised every 2 years. So it's a combination of third-party valuation models as well as appraisals. And then on top of that, we publish every single quarter our accuracy statistics, how far our appraisals were from our valuation models. We publish this on a quarterly basis, and we show the value of your shares changing over time through this. So we take our valuation process. It's probably one of the most sacred things at Flock. It's what keeps our cash flow numbers in check and our leverage ratios and everything about this system in check. So would invite you to learn more. You can watch our earnings calls or just schedule a call with our team to learn more about how we value. And again, just to convey, we send out our cash flow quarterly. It typically happens about 3 weeks after the end of quarter. So end of January, end of April, end of July, and end of October. Another great question here. Do exchangers have the ability to select which portfolio they'll be exchanging into? So the answer to that is today is no. We only have one Flock Homes fund, and that's all residential assets. That's single family homes, duplexes, triplexes, quads, as well as small multifamily. If you currently have an office building or you have a medical practice building, we can't take that into our core Flock Homes fund today. And so just going back to some of the other material we covered, you'd be a great candidate for a DST or there's other 721 exchange providers that we know and we love and we work closely with that we'd be happy to recommend to you. So if you own an asset that we don't take, we'd be happy to put you in touch with others. But today we have that one core fund. It's one vehicle with about $350 million worth of real estate that sits in it. We get a lot of synergies by just working in one vehicle. Just to preview it, because we've talked about this in the past, one day we will have other Flock funds. In addition to a Flock Homes fund, we'll have a Flock self-storage fund. We'll have Flock medical offices. We'll have other asset classes. Our view, though, is that we really want to keep these asset classes separate. They all have their own kind of unique operating nuances, risk, reward profiles to them. So we keep our assets separate. So all of our residential exchangers will go into our one core Flock Homes fund. The one highlight I'll add, because today I'm in the state of California where we have a small office. We also have an office in New York. We don't take any New York or California buildings into our Flock Homes residential. It's not because New York and California are bad. They're just very, very different. And so those are two markets that we will likely launch a separate residential fund for. There's a handful of markets that sort of, right now we're kind of US average, right? We're in Colorado, we're in Kansas City, we're in North Central Ohio, we're in Texas. This is kind of US average housing stock, right? Eventually we will launch kind of more luxury strategies as well as New York and California and other markets like that. And just to clarify one more thing, and there's another question about this. You have the ability to see every home that we own. You don't have to go searching for it. We will show you every single building and every home that we own, and we'll show you the occupancy status of it, how it's performing versus how we underwrite it to. This is all data that we will show you that you'll have real-time access to in your portal. So part of this due diligence process, right? It's not only us due diligencing your building, it's a mutual due diligence process whereby you're due diligencing us, our team, how we operate, right? Our financials, as well as the actual real estate that we own. Is this a portfolio that you're excited about coming into and getting diversification into? Another great question on estate planning. If I pass my shares on to my heirs at death, can they exit all at once, or are there restrictions on their exit? That's a great question from Greg. Greg, the answer to that is they're going to have to follow the same minimum hold period that you signed on to when you joined Flock. So just what does that mean in practice? When you join Flock, you're going to know exactly how long, just like a DST or any other investment vehicle, how long until you can start liquidating. You can't liquidate immediately. This is a private real estate partnership. That would not work. We don't want to work like that, right? We are very conservative. But that let's just say for you, it's 7 years where it's your minimum hold period. After that 7 years, that's when you can liquidate piece by piece or all at once. Your heirs are also subject to that as well. And that's just kind of the guiding, sort of governing guidelines of the partnership that we've created. They will stay on that same liquidation schedule. Another question about fees. We have probably the lowest fee that I know of in private real estate partnerships. It's going up. We charge a flat 1%, now increasing pretty soon. So reach out if you're interested. To be more market, we charge a flat 1% asset management fee. It's going up to 1.5%. As many people here know, if they work with DSTs, typically it's 2% or more. We also do not take any part of the upside. We don't take a piece of the profits. It's not because we don't like money. We do. We just think that it oftentimes incentivizes the wrong type of risk taking. As I talked about at Flock, we are very low leverage. We are very low risk. We are about capital preservation. So we have a flat asset management fee. If you are interested, we are raising that asset management fee within the next 3 months. So please reach out as soon as possible if you want to get locked into that lower fee rate. As we've talked about a lot, fees matter. Even at 1.5%, we will still be more competitive than every DST out there with all the other expenses associated with it. So we think there's potentially even room to push further from that. But if you want to lock in the best fees, please reach out to our team. We also charge an upfront onboarding fee. And the idea here is you would otherwise be paying real estate brokers. You would have other frictions involved with a qualified intermediary. So we have an upfront onboarding fee, 6% onboarding fee, still much, much lower than the DST alternative, as well as an ongoing 1% asset management fee, no carry, no promotes, and no excessive fees on the structuring and all the sort of complicated things that you have to do to set up a Delaware Statutory Trust. A lot of questions here. I'm just browsing through a couple. Another question here. How do I follow up on the share value? You'll have a portal that we've built that you can log into at any time. It shows you your account, shows you every building and property that we own, how they're performing, how our earnings are going every quarter. You track as your account changes every quarter. That new number will repost depending on the performance. And then ultimately, if you want to liquidate, right, that's how much you'll know how much the shares are worth. By the way, as part of that too, we not only do our internal quarterly evaluations, we also do an end of year audit every year with KPMG. We publish our audit that will show to you. You have access to, as your due diligence costs, you can look to every single audit since we launched, every quarter of financial statements if you're interested, going back 20 quarters. So you'll have lots of operating history if you want to dive through that. Another question, can I invest cash instead of real estate into the exchange? The short answer is that is yes. We have a lot of clients who have invested. They don't take their cash flow. Like 45% of our clients do not take their cash flow quarterly. They leave it in, which is effectively just reinvesting it, kind of like reinvesting a dividend. We also have clients who have invested additional cash, either to pay down their mortgage or for other reasons. We have not really built a a marketing effort to raise from cash investors. And the reason for that is simply because we really believe in trying to be the best in the world at one thing, and that is doing these exchanges. We are the only company in the world that is solely dedicated to building the retirement solution for landlords. solely dedicated to the millions of low basis real estate owners who are looking to exchange their real estate into a partnership. And we've gotten really good at that, and we're really proud of that. And so we've just been laser focused on doing that since we started. That provides a lot of benefits in terms of cost efficiencies, how we operate the real estate on an ongoing basis, right? Absorbing these tenants when they come in, these residents, when they come in on the exchange, effectively doing value add work and managing on an ongoing basis. It's just a really powerful dynamic. And so we've just been laser focused on that. But yes, if you have cash that you'd like to invest, at the end of the day, we run a real estate business, so we'd love to have a conversation with you. And you can certainly do that. You can buy shares with cash as well. Great question. Another question. If you own your building in an LLC and there's multiple members, how are they going to get shares in the partnership? We have worked with every entity structure that you can imagine: LLCs, S Corps, C Corps, trust, revocable, irrevocable, LLCs owned by trust, so on and so forth. The very short answer is you can come in however you want, and then you can decide to own shares however you want as well. So we sometimes have folks who come in with an LLC, then they own shares in that LLC, they dissolve the LLC, and the two individual members then own the shares in the partnership. You can do that once you're in Flock. You can do that before. We've seen it all. I'd say reach out to our team. We just brought on an excellent tax director from PwC, who's now with us full time, who will help walk you through those scenarios, who will help model out if there are any tax implications to doing that. Would love to walk you through that. Another great question. If a property has a loan on it, what happens to the loan? So the very short summary here is, let's just say, we'll use it, Greg again, who's had a number of thoughtful questions. Let's say Greg has a $3 million property and a $300,000 loan. So the way that will work is when he exchanges the property into Flock, we will pay off the notes. So rather than him getting $3 million worth of shares in the partnership, right, and that's before the fees, for the onboarding fees, we would just pay off the note and he would have 2.7 million of equity. So rather than starting at 3, he would start at 2.7, just like if he sold the real estate. So we pay off the loan. You know, we have looked at some loan assumptions in the past, but for the vast majority of them, they typically don't work. But if you have an assumable mortgage, we'll look at it. But typically we just pay it off. And we have our own large delayed draw term loan with a life insurance company that we use. And that's how we'll typically finance it. So we'll pay off your mortgage. You are no longer recourse. You are no longer liable. You are no longer a landlord. You are simply a passive investor in a much larger partnership. You are an owner who frankly gets to enjoy their retirements with peace of mind and a lot more flexibility than they would have otherwise. With that, guys, we'll wrap it up. There's still a lot of questions here. So I just want to say thank you all for tuning in today. These were fantastic questions. It's really an honor to be able to work with all these families. We take what you all are entrusting with us very, very, very seriously. So please don't hesitate to reach out. And also you'll be hearing likely from either my colleague Michael or Ethan. Also, don't hesitate to come to our website and put in a chat. There's real people here, and we take a lot of care in what you're entrusting us with and the real estate that we get to own and operate on your behalf, hopefully for many decades and generations to come. So thank you for joining us today. And yeah, it was great to see you, and have a great rest of your day.